I'm here today with Curt Schaller. He's a partner at Focus Healthcare Partners, a new company that he just started. Curt, you and Paul Froning just formed Focus. You've got a wealth of industry knowledge and contacts after several years with Merrill Lynch, Capital Healthcare, and GE Healthcare Finance. How do you plan to put all that experience to work in the seniors housing industry?
Well, I'm fortunate Paul has a tremendous amount of experience as well with Fortress and Brookdale and JER and other spots. And Paul and I, what we really want to do is take advantage of what we think could be the greatest investment climate since the early 90s, the RTC days. And utilizing our experience and our contacts and our reputations to hopefully source some deals off market, some attractive opportunities that will generate great returns. And this is, I really think, going to be one of the best investment climates we've seen in 20 years. And with a partner like Paul, I think we're going to be in a great position to do it.
Okay. And have you put together your financial sponsors and how you're going to get the capital to put into the industry besides your own capital?
Yeah. Paul and I are going to invest in every transaction we participate in, and ultimately our goal is to raise a fund. But we understand what the climate is right now. There's not a lot of capital out there that's interested in investing in discretionary pools. But we've talked to enough people. We've had enough good conversations with some different financial sponsors where we're at the point where we're out there looking at deals, and it'll be on a deal-by-deal basis, and we're completely comfortable with that. I think ultimately you're going to see the traditional real estate opportunity fund investor base come back, and at that point, we'll probably go out and raise a fund.
Okay. And you mentioned that you think this is one of the best times in maybe 15, 20 years in terms of value and opportunities. A lot of people think the name of the game in the next 12 to 18 months is going to be the purchase of secured debt in seniors housing. Are you actively looking at debt opportunities now or in the near future?
We've actually looked at a couple of debt opportunities, but I don't think we're going to necessarily see that gusher of debt opportunities here in the next 12, 18 months. I think LIBOR rates, short-term rates, are going to stay low. We heard Ben Stein yesterday with some of his predictions. So I think as long as LIBOR rates stay as low as they are, it's going to really delay a lot of decisions that banks are ultimately going to have to make in terms of dealing with some troubled loans. And I don't think 12 to 18 months is going to be enough time.
Now, is that going to delay the loans because it's easy for their borrower to cover the interest?
Absolutely. They've got a lot of loans that are covering, but are bad loans.
Because LIBOR's at
exactly
0.25.
But I think the one thing that might actually free up the flow of healthcare real estate loans is the fact that overall commercial real estate market is continuing to see pressure. But again, the overall loan market is being bailed up by low rates.
Right.
Ultimately, without a doubt, I think we're going to see a flood of discounted debt opportunities out there and distressed debt opportunities. But in terms of what Paul and I are trying to accomplish, it's I think going to be a couple years off where you're going to see a significant flow. And I think another part of it is the transactions will happen will likely be larger portfolio sales of loans by large institutions. And then you'll go to those larger institutions and start picking off the healthcare loans.
Right. Okay. And on the equity side, from equity investing, are you looking at startup companies? Are you going to be looking at portfolio's, individual properties?
Our strategy is to look at both individual assets and portfolios, but in terms of startups, although I think the dynamics are great for new construction, the supply-demand characteristics, the fact that the availability of construction debt is so limited, I don't think we really look at that sector. And also just the time frame, the startup, the pre-development, the construction, the lease-up. We think there's plenty of good opportunities out there right now that are significantly under replacement costs. That to spend a lot of time focusing on new construction really isn't the best use of our time.
But how about startup companies in terms of a new entity that wants to start with a 5, 10, 15 property platform acquisition, that kind of thing?
I think in a similar vein, Paul and I are going to be looking at very opportunistic deals. So really what we're looking for are troubled situations. and not necessarily troubled from an operator has failed in his business plan, but maybe a situation where the borrower's done everything they can, but they're just stuck with a bad debt structure. And so for us, it's going to be more opportunistic than working with a startup venture, which is more of a pension fund play.
And when you say a bad debt structure, that's a euphemism for too much debt.
Yeah, exactly. Too much debt, and also maybe just bad timing in terms of facing a short-term maturity.
Right. And then what kind of exit strategy for your investments are you looking at, and how far out, and how are you going to execute the exit?
I think the only realistic exit underwriting you can really have right now is a REIT sale, selling to a REIT. In terms of underwriting some sort of takeout from a fund, using what used to be traditional in Fannie Mae, Freddie Mac, or bank debt, I think that's really unrealistic. I mean, obviously Fannie and Freddie are still out there and active, but are they going to be there in the same way in 2 to 3 years? And that's the exit strategy we're looking at. We're looking at 2 to 3 year holds, obviously maybe longer. So Fannie and Freddie's there today, but to underwrite to an execution using their debt, I think is unrealistic. And so certainly we're going to be underwriting a much more conservative, exit strategy, and I think it's most likely the REIT market.
Okay, and do you have any split you want to do between skilled nursing on one side and the assisted living, independent living on the other, or it just doesn't matter?
Well, we are focused healthcare partners, so we're going to be focused on healthcare real estate assets, senior care, skilled nursing, medical office, and hospitals.
Oh, we've been doing hospitals too.
But realistically, I think in the next 12, 18 months, it's going to be the private pay senior housing market and medical office that we'll be focusing on. With the RUG changes coming down the road and regulatory changes and other reimbursement changes and Obamacare brewing, I think skilled nursing in hospitals is a little too hot for us to touch right now. Right. But the reality, that's going to be down the road 12, 18 months, a whole new slew of great opportunities.
As I say, that might be where the opportunity.
Absolutely.
Healthcare reform and Medicare, Medicaid gets straightened out a little bit. That may be where you go.
Yeah, there's going to be change. With reimbursement and Medicare, obviously, and Medicaid budgets tightening, and there's going to be winners and losers. And much like PPS, it's going to create a lot of investment opportunities.
Okay. And then lastly, do you want to invest with existing operators, or would you look at some properties portfolios and bring in a new operator to run them?
We'll absolutely look at both. I think the situations where we're talking to existing operators are what I mentioned earlier, where you've got a good deal with a good operator, but they're a victim of circumstance. They got an impending maturity. They're facing a market where they can't refinance, and so we'll come in and work with that group, bring capital to the situation to solve their debt problem. So I think that's how we'll be operating with existing operators. But if you truly have a busted deal, we'll absolutely be looking for a strong operator to JV with. We want that operator to be invested in the deal with us to help turn around a broken business plan.
Okay. Well, good luck. I hope you find lots of opportunities next year, and wish you great luck in doing it.
I appreciate it.
Thanks for spending time with us.